Okay, then I think we are good to go. Thanks, Shana. Last week we had Vessel presenting, and I was manning the chat box and answering questions. So I'm on my own today. So if you wouldn't mind, you're more than welcome to type in questions, and hopefully I'll spot them as they come up, and I'll address them verbally as the questions arise. So I'm going to stick to the script today. This is quite a long session, and I'm going to try and cover it in an hour. For those of you who were in the webinar last week, congratulations. You all got passed through the assessment, so well done. Very intelligent bunch, and hopefully the trend will continue. We all live in hope, don't we? Okay, so let's get on with it. So what are the outcomes we're looking for today? So to understand how to determine a risk profile, there are three elements of a risk profile. To have the knowledge to be able to better educate clients on the question of risk and return, to gain a better understanding of portfolio risk and volatility, and the importance of appropriate asset allocation, and then also to be given guidance on how to credibly determine risk tolerance, client needs and objectives, and how to illustrate the effects of volatility and the capacity for risk. And then finally, to be able to match a risk profile to an appropriate and suitable investment solution. Now, I've got these two words, appropriate and suitable, in italics, and for the simple reason that these are very, very important words, not just because I say so, but this is the general consensus around the world, and a lot of phase ombud and determinations go around these particular two words, appropriate and suitable. And then in the context of the South African environment, how to simultaneously embed the principles of COFI and TCF into your investment process. Okay, so I'm advancing the slide. So in terms of the COFI bill, you all would have been given access in the waiting room to download all sorts of reference documents, and one of them is the explanatory paper on the COFI bill. And what is COFI all about? So I'm going to read to you a very brief introduction to COFI, and this is directly from the discussion document. So it's something that brings together all the pieces of legislation and regulations that currently exist in the financial services arena. There are 13 pieces of regulation that will be consolidated into one. And COFI, in our world, the world where phase predominates, COFI will replace phase. So you need to get your heads around the dictates of COFI. And so what we're going to do is look at what differentiates COFI in principle, sort of high level, from all these other bits of legislation that we need to adhere to. So if we look at revision of the legal framework, now I'm going to read from the discussion document. The revision of the legal framework aims to significantly streamline the conduct requirements for financial institutions that are presently found in a number of different financial sector laws. As I mentioned, there are 13 of these that are being consolidated into this COFI Act, currently just a bill. We don't yet know exactly where it's going to be promulgated, but it's imminent. The proposed conduct of financial institutions, COFI bill, will not only replace conduct provisions in existing financial sector laws, but will build a consistent, strong, and effective market conduct legislative framework for all institutions performing financial activities. So how will these proposed changes impact on financial planning practices and how investment advice is delivered and monitored? And I've made a note on the slide. Now, just something else I should mention, and wherever there's a slide that I get to where there's going to be a question, I'm going to say, please take note. So I'm saying to you, please take note. because there is going to be a question that's posed around this slide. So you've got access to the documents. You should be able to refer to pages 11 and 12 of document number 15. So that is the discussion document. So a little description at the bottom of the slide. Principles-based regulation means moving away from reliance on detailed prescriptive rules and relying more on high-level, broadly stated rules or principles to set the standards by which regulated firms must conduct business. So if we translate that into layman's language, what it's really saying is it's just going to tell us what the objectives are and the outcome that needs to be achieved, but it doesn't say how. And this is what this webinar series is all about. It's about interpreting what the spirit of the regulations are, the principles that they're trying to embed in our advice processes, but we have to work out how to do it. So, and over the years, I've applied my mind, hopefully quite diligently, to the point where we've developed processes which have been demoed on a couple of occasions, 2 occasions to be precise, to the Financial Services Board. And the comment that came back after having demoed was that any advisor following our processes will be fine with the FSB, now the FSCA. So bear that in mind. We've done the work. We've taken it to, call it next level. We've taken it to the nth degree, and we've based it on not only experience, but also on determinations, which Vessel spoke about last week. So let's go on to the next slide. And I'm going to say, take note again. So looking at chapter 3 of the COFI bill, let me just find my way through. So we're talking about culture and governance now. So this is on page 44 of the document that you would have. And I've said towards the bottom, refer to section 6, pages 40 to 50. So this is where I'm going to be concentrating the extracts that I'm reading to you. So in terms of culture and governance, chapter 3, I'm going to read to you an extract. So just bear with me. This chapter is a key component of the drive towards improved overall market conduct in the financial sector. The general principles specified in this chapter include that a financial institution must, at all times, and now I'm going to go through a series of bullet points, conduct its business with integrity, conduct its business with due skill, care, and diligence, organize and control its affairs responsibly and effectively, maintain adequate financial and other resources, observe proper standards of market conduct and of conduct of business, pay due regard to the interests of its financial customers and treat them fairly, pay due regard to the information needs of its financial customers and communicate information to them in a way which is clear, fair, and not misleading, manage conflicts of interest fairly, take reasonable to ensure the suitability of its advice, and discretionary decisions for any financial customer who is entitled to rely upon its judgment. Arrange adequate protection for financial customers' assets when it is responsible for them, and deal with financial sector conduct authority in an open and cooperative way. That's quite a mouthful, but I think pretty much self-explanatory. I know it's not exactly bedtime reading, but I would urge you, read through this document, get your heads around it, because this is the bedrock upon which our industry is going to lay down foundations and start to grow. So now we look at financial products, so chapter 4, so that's on page 47. The design and performance of financial products can be directly linked to the outcomes that financial customers experience. Financial products should be developed to meet a clearly identified and legitimate customer need. Chapter 4 sets principal requirements to ensure that financial products are designed to meet customer needs, are targeted appropriately, and perform as expected. Financial institutions are expected to have a written product oversight and governance policy in place. I think we'll have to refer to our compliance officers to be able to comply with that last dictate. Financial institutions are expected to have a written product oversight and governance policy in place. Another piece of regulation, another piece of compliance that we've got to deal with. But, you know, this is our industry and we have to comply. Otherwise, we run massive risk. But in this chapter 4 that I've just read, sets principal requirements to ensure that financial products are designed to meet customer needs. In an investment environment, that implies some form of outcomes-based investment process to ensure that you build portfolios that not only match the risk profile, but also achieve the rates of return required to make sure that the plan works. But we will talk about that in the next module and in module 4. So this is kind of setting the scene. Then if we look at financial services, that's chapter 5 on page 48. Similar to financial products, the manner in which financial services are designed and provided to customers can impact on customer outcomes. Chapter 5 contains similar provisions to Chapter 4 in requiring a financial institution to consider the needs, circumstances, and expectations of targeted financial customers when providing financial services. It also required institutions and representatives to remain aware of the impacts of financial services on customers indirectly impacted through another financial institution. I'm not going to go and try and interpret that. There's a lot of meat on this bone, and this document on its own, I think, pretty much warrants a webinar concentrating purely on this. But once it's in its final form and it's been promulgated, then I think it bears looking at. Then we look at promotion, marketing, and disclosures. Financial institutions should promote, market, and disclose information about their products and services in a way that promotes informed and confident decision-making by the customers. This chapter requires financial institutions to have documented processes and procurement in place for signing off promotional and marketing materials by a person of appropriate seniority. Certain requirements for the presentation of promotional and marketing material are specified, and prohibited marketing practices are specified. The chapter also ensures that lines of accountability remain clear. Then we look at distribution, advice, and discretionary investment management. The manner in which financial products are sold and distributed can create poor customer outcomes, particularly when incentives drive behavior that is not in the customer's best interests. This chapter sets requirements for financial institutions to apply when choosing channels or developing models to distribute their products and services. It addresses sales practices that rely on intermediated distribution models and those that involve direct selling. I know I'm sounding like one of those old-fashioned broken down record players and repeating myself. Please read the document. Like I said up front when I was positioning this document, it's principles-based. They're stating what principles they're looking to achieve, but they're not saying how. So we've got to make a best guess at that. And then post-sale barriers. Chapter 8 aims to introduce consistent approaches and practices amongst financial institutions once a customer has purchased a product or entered into a contract with a financial institution. The practices of financial institutions should not lead to unreasonable barriers to customers switching products or exiting when necessary. There are clear requirements for claims handling processes where applicable conduct requirements are provided for practices related to the renewal of contracts. The chapter also entrenches requirements for the complaints management processes within financial institutions, including interactions between a financial institution and the relevant financial sector ombud, and requirements for how the information generated through complaints are used within an organization. So, This is a very, very big and meaty slide. And as I said, there is a question attached to it, so please take note. Let's move on to the next slide. We've spoken about culture and governance. We've spoken about product suitability. We've spoken about disclosure, suitable advice. These are all the TCF principles now. So there's a bit of something repetitive about this. So like I said, COFI is looking to consolidate 13 different pieces of legislation. And I'm assuming that TCF will be drawn into that ambit as well. So let me just find the document that I need to refer to. So TCF is all about treating customers fairly. So fair treatment of customers underpins the general code of conduct for financial service providers. So general code of conduct is part of phase. So by implication, TCF is going to be drawn into COFI. While the principles embodied within the outcomes may already form part of the culture of an FSP's business, the demonstration of the outcomes may not yet be in place. And changes to some business processes may be required, and in some cases, new processes may need to be implemented. Now, this paragraph talks very clearly to the objective that we're looking to achieve, the outcome that we're looking to achieve. So by the end of this webinar, you should have a pretty good idea of how to reconfigure, if it's necessary, or adapt your business to fall in line with the dictates of TCF. Please bear in mind this slide, pay due attention to it because there is a question attached to it. So let's look at the different outcomes. So outcome number 1 is culture and governance. Let's see what I've got here that I can read to you. Customers must feel confident that they are dealing with an institution where TCF is at the core of their culture. That's outcome number 1. Outcome number 2, product suitability. Like I said earlier, suitability, appropriate. These are words that keep coming up and you need to bear them in mind. Products and services in the retail market which are sold and marketed are designed according to the needs of the customers identified and targeted accordingly. So that's outcome number 2. Outcome number 3 is around disclosure. Customers are provided with clear information and kept appropriately informed before, during, and after point of sale. Outcome number 4, suitable advice. Here we go again. Advice is suitable and according to the customer's circumstances. Outcome number 5, performance and service in line with expectations. Service is of an acceptable standard and products perform as customers have been led to expect. This talks to what I alluded to earlier, outcomes-based investing, where you create a solution that not only fits the risk profile, but ensures as best as is possible, in a very uncertain investment world, I might add, that the plan works. And when we talk about outcomes-based investing, I'm laboring this point for a good reason. You know, it's so easy for us as financial advisors to attend workshops and presentations delivered by fund managers, and there seems to be this preoccupation with looking to be a top quartile performer, always being in the top, and it looks like every presentation I go to, everyone's in the top quartile. So, you know, one has to be able to discern as well. And we will talk about the science behind really comprehensive due diligence processes, fund research and manager research, and that will be part of module 3. So that's going to be interesting. But that talks to this outcome number 5, outcomes-based investing. Services is of an acceptable standard and products perform as customers have been led to expect. That's a big dictate. Outcome number 6, claims, complaints, and changes. customers do not face unreasonable post-sale barriers when they want to change a product, switch providers, submit a claim, or make a complaint. So TCF is a regulatory framework set up by the FSCA and which governs the way an FSP conducts daily dealings with its clients, ensuring that all clients are treated fairly during all stages of the product cycle, life cycle, and the advice process. So the TCF framework, and I'm just reading from the slide, I know you're more than capable of reading. The TCF framework is built on principles that help drive the FSP's business conduct towards a set of 6 outcomes. FSP therefore needs to move towards a place where their business practices achieve these outcomes and eventually become an inherent part of all areas within the business. Documenting the implementation of a new business process or changing an existing process therefore becomes a fundamental part of the FSP's TCF journey. These 2 little sentences hold enormous significance when you, as an IFA, take an introspective look at your business and say, how do I run my business? How do I construct my advice processes? These 6 outcomes are the foundation upon which that question should be addressed. And if I'm not mistaken, there is a question attached to that as well. Let's go to the next slide. So I've already read through all of this, so I think we can skip on to the next one. So sort of kill 2 birds with 1 stone. So risk profiling in practice. Here I'm referring to document number 5, and it's called Risk Profiling, Art and Science. This is a document that was put out a number of years back, but the fact that it might be a year or 2 old does not impede in any way on the significance and applicability of the document. So I'm going to go to page 10 of this particular document, and risk profiling in practice. And the first point I've got is assessing risk required. So I'm going to read from the document. And once again, not exactly bedtime reading, but I would urge you it'll take you half an hour to go through this, and it'll really enlighten you and probably set off some light bulbs in your minds. How can risk be required? Strictly, it's not risk that's required. Rather, the projection capabilities of good planning software are used to determine the return required to achieve the goals, given the resources available. There will be a level of risk associated with that return, and this is the risk required. So I'm giving you very brief definitions of these terms. Then assessing risk capacity. Once again, reading from the document, unlike risk required and risk capacity, which are financial parameters. Sorry, I've jumped ahead. I missed one here. Assessing risk capacity. Risk capacity is the extent to which an individual financial plan can withstand the impact of unexpected negative events. Now, risk capacity is a fundamental part of determining a risk profile. So, and a lot of advisors, in my experience, people that I've come across and I've asked the specific question, they determine risk tolerance, they determine needs and objectives, but they don't address the third leg of determining a risk profile, and that's capacity. And I've applied 2 sort of interpretations of the term capacity. So it's the capacity of the plan and the ability of the person to contend with the uncertainty that goes around volatility. So I'll show you an example just now of how capacity can impact a plan. And if it's not properly addressed and written down and agreed, you could, when I say you, the financial advisor, his advice process could well be jeopardized if he hasn't really credibly addressed this whole question of capacity. Then talking about risk tolerance, unlike risk required and risk capacity, which are financial parameters, risk tolerance is a psychological parameter. Risk tolerance is how an individual feels about taking risk. Where does the person strike the emotional balance between seeking a favorable outcome versus risking? And then identifying and resolving mismatches. Now, that's another big question. Just getting back to risk tolerance. Psychologists have been studying risk tolerance for more than 60 years and have developed a substantial body of knowledge, which has only recently begun making its way into finance and economics. Risk tolerance is a psychological characteristic, a relatively enduring way one individual differs from another. It's like a personality generally. Risk tolerance is a function of nature and nurture. In other words, it's in your DNA and it's part of your conditioning, genetics and life experiences, and is largely settled in early adulthood as it is a personality generally. Risk tolerance does decrease slowly over time, as with other aspects of personality, and it may be changed by life events, but otherwise is fairly stable, even through financial market highs and lows. I'm going to go into risk tolerance in a little bit more detail, a little bit further on, but not at this point. I'm just sort of laying the foundation for what we're going to be chatting about just now. Okay, please take note of this slide. There may well be a question attached to this. But assessing risk required. So on page 10, I've already read that to you. So what does risk required mean? The projection capabilities of good planning software to determine the return required to achieve certain goals, given the resources available. The risk required is determined by the level of risk associated with the required return. With risk required, the science lies in the financial planning software being used, and the art lies in explaining the relevant issues to the client. Now, I'm just going to give you a bit of anecdotal evidence here, and it prompted me to put a post on LinkedIn the other day. We've developed these processes, we use them in our practice, and even though we've come through some really testing investment times where returns have been way below par, we get very few phone calls, and a lot of advisors that I've interacted with, it's the bane of their lives. Clients always phoning and complaining about lack of performance and concern about markets. And my stock response is, well, we don't get those phone calls. So I started to sort of question, why is that? And it's all about interacting with the client. It's the last point. The art lies in explaining the relevant issues to the client. So there's a lot goes around education and a lot goes around behavioral finance as well. Understanding behavior, understanding behavioral economics, and also behavioral finance. We start delving into psychology quite deeply, but it's an essential part of our job because the way the industry is evolving, the way our lives are changing, and the dictates of where the skill sets need to be developed for us to play a more significant role in our clients' lives. Once again, that's another webinar all on its own. It's all around behavioral finance. So I'll just go back. I think I've gone out of sequence here. So we've done risk capacity, fair enough. So now I'm going on to assessing risk tolerance. So risk required and risk capacity financial parameters, we've spoken about that. Risk tolerance is a psychological parameter. We've spoken about that. Risk tolerance is how an individual feels about taking risk. Where does the person strike the emotional balance between seeking a favorable outcome versus risking an unfavorable outcome? So my note at the bottom here, a psychometric test does not replace a discussion between an advisor and client, but rather provides an information-rich, objective starting point for that discussion. So now we get into identifying and resolving mismatches. So when and these are just terms that, so Sean, yeah, I see you've posed a question. If risk required is based off backward-looking data, how pertinent is it going forward? As this would infer providing forward-looking models based on assumptions and warnings are attached to past returns. Why not risk? It's a great question, Sean. I think largely your question will be answered in Module 3. And once you've been through Module 3 and you understand the extent and the depth to which you need to go as an advisor in doing your research, getting your strategic asset allocations right, and developing models based on expectations of where the primary factors which do influence markets. So if we look at fundamental economics, where interest rates are going, a big thing today, which causes a lot of uncertainty, as we all know, is geopolitical events. We've got world leaders doing quite a lot of saber rattling at the moment. There are so many factors. So it's about interpreting what the future is likely to look like. It's not an easy challenge. This question, I mean, once again, I've said it a couple of times, this question on its own would form the basis of a 1-hour discussion. But please be patient. I think we will answer this to a large extent in the next module, Module 3, which is due diligence, manager research, fundamental economic research, interpreting investment markets, getting asset allocations right. That's forward-looking. I agree with you. You can't look back. You have to look forward. But you have to be able to prove that you've diligently applied your mind and that the portfolio construction and asset allocations that you've used in matching a portfolio to a risk profile is that there's credible processes behind that, and you can prove that, because there could come a time where you might be challenged by an ombud client, even an attorney for that matter. So these questions need to be addressed and addressed at a highly, highly credible level. So I see Harold's busy typing, so I'll wait for that question to pop up. So when we talk about overshoot, so the risk required to achieve the client's goals with the desired risk capacity is less than the risk tolerance. Undershoot happens because we tend to be overly optimistic about our futures. In both overshoot and undershoot situations, trade-off decisions will be required. The undershoot trade-off is more difficult because the client will have to give something up. So what we're really saying here is that even though a client may have a tolerance that determines that he should have X% exposure to risk or growth assets, he may just not have enough money to be able to stay in what we call the comfort zone, and that I will discuss in a lot of detail in Module 4. But to match the investment solution and the exposure to risk with his risk tolerance, it very seldom works that way, for the simple reason that people just don't have enough money. So sometimes you have to take on more risk than you're wired to take. So the challenge then is to determine that gap. So where you're comfortable in terms of your risk tolerance, but because you don't have enough money and you've got to take a little bit more risk, there's a gap between the two, and you have to have a discussion around that gap, and then clearly agree with the client that you are stepping out of your comfort zone, taking on more risk because that's what your circumstances dictate. So overshoots, undershoots, it's very seldom overshoot where your risk tolerance is way higher, but because you've got enough money, you don't have to take the risk. So what's the point? Whoopsie. Are you still with me? Are you seeing the presentation? Because my screen just flicked to somewhere else. Are we still okay? Someone can just say yes, fine. So Harold, you've typed in, Sir Benjamin Franklin once said, all investors understand that they can lose money. However, when they lose money, they lose understanding. Well, there you go. That's a bit of a metaphor, but it certainly holds true. Benjamin Franklin was around, I think, in the 1700s, if I'm not mistaken. So nothing much has changed. So with mismatches, the science lies in identifying the mismatch, and the art is in the guiding the client to an acceptable resolution. Can someone see Sean is typing? Okay. Out of my control, I'm afraid. So let's talk about some risk profiling mistakes. And once again, we're referring to risk profiling, art and science, and it's on page 16. So I'm just turning to page 16. And some of the common mistakes, projections may be based upon historical data. And I think, Sean, you raised the question just now. It's got to be forward-looking. Optimistic assumptions on rates of return. One has to always err on the conservative side, make realistic assumptions, don't create false expectations, don't create a trap for yourself when you paint this rosy picture and then you don't deliver, or the markets don't deliver. Underestimating life expectancy. Now, that's another thing. This is a question one has to ask when you're putting together a retirement plan. Have access to mortality tables. So a person, let's say a male of 65, today is probably expected to live to around about just close to 80. But then you ask questions about longevity in the family. How old is your mom when she died? How old is your dad when he died? And people are living longer because of medical advances and so on. That creates its own problems because you can live longer than your money. So you've got to come up with a realistic age to plan to. Use simplistic risk tolerance questionnaires, not dealing with inconsistencies in the risk tolerance questionnaire. Now, I'll talk to you about that just now, but I will cover it in a lot more detail. So I'm really just going to touch on it. And the inability to translate a risk tolerance score to an appropriate asset allocation. It must be remembered that a risk profile is based upon information and decisions made at a particular point in time. While risk tolerance may not change, everything else may change. And the risk profile and the plan, therefore, needs to be regularly reviewed. And that's part of your value proposition. When I say your, talking to financial advisors here, it's part of your value proposition, part of your service level agreement. So this next slide, it's a graphic, and it just sort of pictorially identifies the process. So, and once again, all around suitability. Know the client, determine the risk profile, understand the circumstances, understand the goals. This is part of the interaction with the client. And these are elements that need to be built into the advice record. The product, know the product. We have spoken, I think, at length about the particular product that we would use in this particular environment, and that's the investment portfolio. So knowing the product is understanding the architecture of the product, understanding the process of building the portfolio, understand the process of managing the portfolio, making sure that the portfolio is always in alignment with the risk profile, the needs and objectives, the tolerance, all those things. justify the connection, explain what connects the client to the product. I think I've just covered that point. Informed consent, where there are gaps, for example, and I'll show you a slide just now, but for example, where a person may have a risk tolerance score of, say, 40, 45, that in the world that I work in and the tools that we use would imply that a suitable product would be something with an exposure to growth assets of around about 40%. And if you take that, then as an advisor with a bit of experience, you've got to say, okay, so if we have risk assets or growth assets of 40%, what is the kind of return that we can expect in today's current environment and our expectation of what markets are likely to deliver going into the future? Sean, going back to your question, looking forward, for the past 5 years, we've gone sideways, but the 5 years prior to that, you could put any old portfolio together and you'd hit the jackpot. Not anymore. There's a very interesting document that I read the other day, put out by a fellow. He's an Australian guy. He's an advisor, but very, very highly regarded, good reputation. And he put out a document that said, advice begins when returns end. Now think about that. Advice begins when returns end. So, and this is where informed consent comes into it, because if things don't go according to plan, you've now got to put on a very different hat. You're not just an investment advisor anymore. You're a confidant, you're a coach, you're a mentor. It's all the soft skills. It's the empathy. It's the understanding. It's knowing your client. And then, of course, getting to the last one, maintaining. Monitor and maintain. Client reviews. Review the product, review the plan. I think I've covered this, and I spoke very briefly about risk tolerance scores and exposure to growth assets. And I think it's a natural thing. The higher your risk tolerance, the higher the exposure to growth assets that you can have, the higher your expectation of returns. But sensitivity to volatility needs to decrease as well for you to tolerate this kind of exposure. So you should be equipped to build on your client's risk profiling experience by educating them about risk and return, so as to manage their expectations and explain the risks of the investment strategy being recommended. These are time-consuming things that you need to do, but it's around two things. So CYA, cover your you-know-what, but also ensuring that the client understands and has a good outcome. And the CYA means being able to be in a position to answer questions at the highest level if ever you're challenged, either by a client or by an ombud. So the risk tolerance tool that we use, I did a lot of research and determining which risk tolerance tool to build into our process. And I settled on Philometrica. It's a tool that was developed in Australia, and it's now commonly regarded as being one of the best in the world. It's a psychometric. So we send out a risk tolerance test invitation to a client. They then get a link, they click on it, and they go through and answer 25 different questions. And then there's a few demographic questions as well. But every question took approximately 4 months to hone and not manipulate, because that has a negative connotation, but get it worded in unambiguous terms that a client can understand. It was put together by psychologists, it was put together by academia in Australia, and it's been tested around the world, and it's one of the best. There are schools of thought that don't go much with the whole risk tolerance thing. They prefer to start at what we regard as the end point. What is the rate of return required? How much risk do we have to take? Keep it simple. Anyone following those kinds of philosophies and processes, I think, well, say courting disaster might be a little bit alarmist, but the precedents have been set. Ombud determinations are there, and the Ombud says you will determine risk tolerance, you will determine needs and objectives, you will illustrate capacity and talk about volatility and discuss it with your client. So if you're doing anything else, however you might argue to try and justify a different way of doing things, I think you're stepping into a minefield. But there are people out there that think they know better, and that's fine. I'm just, we built a process around how we interpret the regulatory environment. So your risk tolerance score enables you to compare yourself to a representative sample of the adult population. When scores are graphed, they form a bell curve, as illustrated. And to make scores more meaningful, the 0 to 100 scale has been divided into 7 different risk groups. So here we go. Risk group 1. And you can see the bulk of people sit in risk groups 3, 4, and 5. So, and the scores range from 25 on a scale of 0 to 100 up to 64. So here's a person who may have scored a score of, say, 56, 57, so they're in group 5. So there's a database of people that have used this risk tolerance tool. It's about 1.2 million around the world. So there's no geographic influences. This is human nature. And when you answer those 25 questions, if there are any questions that you answer that are not consistent with the rest of the risk group, that becomes a conversation that the advisor and the client need to have. Why did you answer the question that way? You're contradicting yourself. And if the client's adamant, that's fine. So you record it in the record of advice and you've covered yourself. I've had clients who get, and when you are answering consistently through those 25 questions, you get green ticks. If you get a yellow tick, that's kind of either side. So you might be in risk group 4, risk group 6. Then if you go into the red, you could be in risk group 7 or risk group 2, which is way inconsistent. So you need to have these discussions around the risk tolerance test and the report that comes out. Sean, you've posed a question here. Marketing spin and company-specific jargon and products make it extremely difficult for any advisor to be technically sound of competing company offerings. I'm not quite sure what you're referring to there. Prepackaged products, lifetime products, yeah, those tend to be sort of less transparent than we would like them to be. So, when we build solutions, we are as transparent as we can be. We do the research, everything, all the costs are disclosed, the investment mandates, the manager styles, the strategic asset allocations. So all of these are pretty much laid down and cast in stone. Recently, there was a determination which you may have heard about, and this question just kind of prompts the response. It was all around this unit trust, CIS company called Third Circle, and they were on the MET Collective Investments platform, and they had a mandate, and it was approved, and it was running for a couple of years. I think they ended up with about 350 million rand, so it wasn't a big fund. But recently, a determination was passed where METCI, Metropolitan Collective Investments, they were hosting this fund. In 2015, when Nene was fired, that fund, the fund manager had been lured into the beauty contest. He was trying to outperform and get cute. So he had exposure to all sorts of derivatives, and he had stepped right out of his mandate. And there was the FSCA recently ruled against METCI because there was no oversight. They weren't ensuring compliance, and they fined them 100 million rand. That was on a 350 million rand fund. Now, where that money goes, that's a question I can't answer. So next in line, and I created a graphic saying the dominoes are starting to wobble. So the first domino to fall was Third Circle. The next domino to fall is MetCI. They're challenging the ruling, but they've been ruled against, 100 million rand. Then comes the FSPs, the KRs, the representatives, and so it goes. So there's going to be a knock-on effect. So getting back to marketing spin, specific jargon, understanding products, lack of transparency, that's what TCF is talking about. It's about transparency. It's about understanding the products. That's what these pieces of regulation and what COFI is going to do. So hopefully the product creators, the product providers will heed these rules and structure their products accordingly. We live in hope. Whether it happens or not remains to be seen. So getting back to risk tolerance groups. Risk tolerance, as with all aspects of personality, is determined by genetics and life experiences. Essentially, it's settled in early adulthood. Typically, it does not decrease slowly with age, as with other aspects of personality. Sorry, it does decrease and may be changed by major life events, good or bad. So this is the starting point of determining a risk profile. Then getting back to, and I think one or two of the questions that Sean has asked start leading into this slide. So what Phonometrica have done in their in this risk profiling art and science is put together some suggested asset allocations for the different risk scores or risk groups. So people in relevant risk group 1, 2, and 3, who are very conservative, may have 100% defensive and zero growth. In other words, no risks. So that would be cash, fixed interest, international, fixed interest, and that's it. Then if you go to sort of middle of the road, portfolio number 6, so it says balanced number 2, so that would be applicable to risk tolerance groups 3, 4, and 5. The particular example we used, I'll go back the slide, this person was group 5. So this portfolio would fit quite nicely, perhaps even portfolio number 7. So let's go with that. So defensive assets, 40%, growth assets, 60%. So this is now where we start talking about exposure to risk and risky assets. And what are growth assets? It's equities and property, local and offshore. So a typical asset allocation would be 10% cash, 20% SA fixed interest, in other words, bonds, international fixed interest, 40% locally listed shares, 20% offshore equities. This gives a guideline. Whether or not it would always be appropriate at any points in different economic and investment cycles, it gives you an idea of the fundamental thinking and planning that you need to indulge in. Now, whether or not you as the financial advisor have the experience to be able to do this all yourself, well, there's not too many guys that have that kind of experience. So you need to start looking at getting in independent research. Risk tolerance and illustrate capacity. All right, this graphic, we've all seen that, the investment cycle and how the herd operates. At the highest risk, most people are buying or at the highest point, most people are buying. At the lowest point, they're selling, where it should be the other way around. So I'm kind of bringing coals to Newcastle here. So in determining risk tolerance and illustrating capacity, the volatility characteristics based upon various asset allocations. So that was the previous slide. And that then starts the conversation around return expectations, the sensitivity of the client to volatility, sensitivity of the plan to volatility, and the investment experience at the end of it all. So this is now talking to capacity, and it's the one area of risk profiling that I think is pretty much neglected. A lot of people are just not paying attention to this element of risk profiling, and as I said earlier, at their peril. So an investor's actual experience will depend very heavily upon investment market conditions during the period of the investment, and these can vary widely between periods. We know that. We've come through a very challenging time. I was looking at some of the portfolios that we run this year, and we've had quite nice returns. We haven't shot the lights out. When it comes to outcomes-based investing, the objective is to build portfolios that capture some of the upside, perhaps not all, but limits the downside. And there's the real art, is limiting the downside. When markets are falling, you don't want to capture all of the downside. So you're kind of flattening out the peaks and the valleys of the performance graph and giving people more of a predictable outcome in line with the targeted returns, whether it's a CPI plus 4, CPI plus 5. If you've achieved the rates of growth that you've used as assumptions in your plan, then you've done your job. Your job is not to outperform the rest of the market. Needs and objectives: using a credible and accurate investment retirement planning tool and taking into account all factors that can impact the plan and the client's needs and objectives, and agree on the rates of return required to make the plan work. I've already spoken about that, and we'll cover this in a bit more detail. We'll look at one or two solutions that people can consider using, or the types of solutions they should be looking at. I've spoken about outcomes-based investing. I've spoken about life expectancy of the client and the life expectancy of the income and the capital. You don't want to build a plan where the person lives longer than his money. And scenario testing and volatility simulations, that addresses the whole capacity thing. And I've made a note down here: preferably use a tool that's A, easy to understand, interactive, educational, and inclusive, so that the client understands and accepts the outcome and the resultant plan and the agreed assumptions. We do that. We spend an extra hour or two with the client, getting them to understand. And this is one of the things that has resulted in us not getting that many phone calls in terms of markets not behaving. So, Sean, who controls the asset allocation, active, passive asset allocation? How often is this rebalance determined by what triggers? So now we're stepping into portfolio construction. For an advisor to make these calls, unless he has a CFA and he has all the tools and resources available, I would not venture to say that an advisor is equipped to do this. We have outsourced our research to an independent research house. They do all of this for us, and we pay them for it, so that when we build portfolios, and we have an investment committee, and there are so many different methodologies of building portfolios. The whole thing around active and passive, the debate will go on and on and on. If you're driven by cost, then passive maybe will work, but passive in a falling market can be a bit of a challenge as well. Then you've got to look at the different indices that the passives are linked to. There are so many different investment styles, both in active and passive. So these are the discussions that take place around an investment committee table with the resources available to back up any decisions. Asset allocation, yep, you've got to be able to interpret economic cycles. Where's the economy going? Are we in an inflationary environment? Are rates going to go up to try and control inflation? What's the view on whether we get a downgrade? What's that going to do to our currency? There are so many things to consider. For one advisor who's trying to do everything, he's treading in a minefield. So what are the triggers? It's about interpreting economic events. When we've got benign economic situation where things are just chugging along and everything's quite predictable, the triggers are not there, but you need to be aware of what those triggers are. What happens if the Iranians decide to bomb the Saudis and burn a few oil wells? What's going to happen to the oil price? What's going to happen to the supply of oil? Is it going to trigger a war? Geopolitical things start to happen. There are left field events that they're left field. They come out of nowhere and most unexpected. But that's the way it is, and it has been for many, many years. So it goes back to having a credible process that's well-founded, with the right skills, with the right people driving it, and with appropriate interpretations to be able to A, protect yourself, and B, ensure as best possible a favorable outcome for the client. I don't know if I'm answering your question, Sean. These we could sit around the table all day and discuss these things. I've got certain insights into them. I don't regard myself as being an expert, and the mere fact that I outsource this stuff to people with the appropriate qualifications and experience, tools, resources, I think that says it all. So I think we are pretty much at the end of it because of the little hiccup we had. I think we've overshot. So I'm going to sort of sign off as far as the presentation is concerned. So next week we'll chat about building and managing portfolios. So Sean, I think a lot of your questions are going to be answered, and how to perform an investment due diligence. Now, we've outsourced this particular function of our business and our portfolio construction and management to independent investment advisors down in Cape Town. 2RP is the acronym, and that's how they refer to themselves. So this is a group of multi-manager specialists. They've been around a long time, highly qualified, highly skilled, and independent. So they have nothing to influence any decision making. They look at things in the cold, hard light of day, and they give independent, objective advice. And it shows in the performance of the portfolios in terms of outcomes, the good outcomes for clients. So I think we can equip IFAs who attend our webinars. Will certainly plant the seeds of being able to build credible portfolios using bulletproof process. I say bulletproof, and I mean it. And having chatted to the FSB on a couple of occasions, I've already said, any advisor following your process will be fine with us. That's all you want to hear. That's all you want to know. All right, so Sean, you typing another question. I'm going to wait for you. I hope everyone's got a bit of time. We've overshot by 10 minutes, and then we'll go into the assessment. Come on, Sean, hurry up. I thought you were a touch typist. Where do we find the document you referred to? Which document? Okay, risk profiling, art and science. So that you should have found it in the waiting room for download. But what I'll do, if you haven't got it, I'll send it to you. I'll do it, once we finish here. But so it's document number 5. If you haven't got it, just let me know, Sean, and I'll send it to you. Anyone else for that matter, if any documents you haven't got, I'll send them to you. Okay, so I'm going to close the webinar now, or the presentation part of it. So you're going to see the slides disappear now. And thanks everyone for listening to me droning on and on and on. Hope you found it useful. So time to find out how smart you were. If last week is anything to go by, I have utmost confidence in your ability to deal with the. All right, Lucille, don't disappear, because we're going to do the assessment now. So I'm going to close the presentation.